So the next piece that we always discuss at year end is what's called QBI maximization. QBI stands for qualified business income. And essentially what it is, to give you a little bit of a background, is about 8 years ago when the Tax Cuts and Jobs Act was put into place. You'll probably remember one of the biggest benefactors of that bill was the reduction of the corporate tax rate. It went from 35% down to 21%. And in a vacuum, completely isolating that variable right there, everyone would have converted to a C Corp if you can lock in the 21% rate. So they had to level the playing field a little bit. And what they decided to do was put in a 20% deduction on certain pass-through income. So coming through from an S corporation, a partnership, a single member LLC, you get an immediate 20% deduction on that pass-through income, which, in most cases could be the largest expense or deduction that you'll see on your return for your business income. Now, that being said, there are very limiting factors that come into play once you get above, around 150 to 180,000 of total income. There are other variables that will immediately limit whether or not you can take anywhere from 0 to 20%. And so the number one limiting factor there is the amount of wages that are paid out from the entity. And for an S corporation, the way that we'll play with that each year is the amount of reasonable compensation that's paid to the owner. And so you can make an accounting entry, recharacterize more income as payroll to allow for a release of additional limitations on that 20% QBI income, where maybe default treatment, you're only getting 5% because you were paying yourself the least amount of wages.